Welcome to Masters of Risk, the podcast where we uncover what is top of mind for business leaders today. I'm Yashi Yadav, and I will be your host every month. Let's get started. Hi, everyone, and welcome to another episode of Masters of Risk, a podcast by S&P Global Market Intelligence. My name is Yashi Yadav. I will be your host today, and joining me is Nancy Davis, founder and CIO of Quadratic Capital. Nancy, I'm so excited to have you on today. How are you doing?
Oh, thanks for having me on.
So just to kind of, let's get right into it. Let's kick things off. Would you, maybe share a little bit about your background? And I know you are, as I mentioned, the founder of the firm. So what prompted your decision to start your own asset management firm?
Well, I think it really is the American dream, right? To build a business. And I think I had the confidence enough to say, hey, I'm pretty good at what I do. I think I'm one of the best out there. And I really want to hang my own shingle. And I started the firm about 11 years ago, and it's just been amazing. It really is the American dream.
And what were you doing prior to starting the firm, Nancy?
So I spent most of my career prior to my own firm at Goldman Sachs. I was there for about a decade. And they don't exist anymore, but most of my time there, I was on the proprietary desk. So we had no clients. We were just investing Goldman's own capital on behalf of the firm.
Got it. Okay. That's really interesting. I'm sure you learned and took, were in a lot of different interesting situations and probably took on a variety of different risks while you were sitting on that desk. Was there anything while you were at Goldman that kind of inspired you to make the next move, or was it just you were looking for a change?
Yeah, there are a lot of things that inspired me, and I think it was a very entrepreneurial group to be in as well. And I also saw a lot of my other colleagues at Goldman Prop who left the firm and started their own firm. So I had a lot of great, sometimes it's really, and I think that's a great thing about being a guest on your podcast is, I hope that we can inspire, even one of your listeners to say, take the plunge and do it. Because it's so exciting. It's been a wonderful experience. And I actually have been working for my own firm now longer than I work for Goldman, because I was there about 10 years and I've been, Quadratic's been running for since 2013.
Wow, that's quite a feat. That's so interesting when you look back and just realize, how much you've accomplished since then and kind of where you started and where you're at now. When you made the shift into starting your own firm outside of obviously the entrepreneurial spirit and being able to see colleagues that had done it and been successful, was there a particular problem that you were looking to solve or a gap that you were trying to fill?
Oh, it's a great question. Yes. Whenever you, I think, start a firm or do something, because starting your own firm is risky because you have to quit your job and you go from being paid to work to paying to work, right? It's not like you're profitable right away. So you always, I think it's super important to always have a problem that you're solving, right? And I think that was where our niche really came in, is that, we innovated in the financial markets. And sadly, there's not a lot of innovation in the financial market, but I think that really goes back to the core of the success that we've had, because we are solving a problem that exists for people. And when you give, no matter what industry you're in, right? It could be any type of industry, as long as you're solving solutions for your clients and bettering their outcomes, that's what really matters.
And, as much as you can say, I know typically a lot, there's an extent to which you can share your investment strategies, and there's others, that's the secret sauce. But I guess what specific innovation are you referring to in this scenario?
Yeah, no, I'm definitely I think it's very important to be fully transparent. So I'm not one of I know some portfolio managers like to have the mystique of, trust me, we're not going to tell you anything and trust the process.
Yeah.
I'm definitely the opposite of that. I really spend a lot of time on education, and I want people to understand exactly what we're doing and the investment process and sort of what it's trying to solve. So, when I started my career, it was right when the US Treasury Department started the inflation protected bond market. It was in the late 90s. And I was a young trader at Goldman.
Yeah.
And I remember thinking, wow, that doesn't make any sense. Like, that's stupid. So TIPS, which is an acronym for Treasury Inflation Protected Securities, they just started recently. Like, if you think about it, like, I'm not that old. But a lot of people look at what happened in the 70s and 80s to measure inflation. And I like to grab people and be like, look, there was no inflation protected bond market in the 70s and 80s. There was no, rates market in the 70s and 80s. So people look at things like commodities because that's all that existed. And so I think it's really important to say, like, these markets are pretty new. One of the big problems we were trying to solve is the only index that's used within the Treasury inflation protected securities is the CPI index, right? It's just like S&P, you have a lot of different indices, right? There's not just one index, and inflation is an incredibly complex and difficult thing to measure. Even the Fed doesn't use the CPI index alone, right? There are lots of other ways to look at inflation. It's really hard to measure it. And so I thought it makes no sense to have only CPI inflation being measured. And then the other big problem with TIPS is that all TIPS are long duration, right? They're all bonds, and they will all lose money when interest on their duration exposure. So we're trying to solve for the problem with TIPS having duration. And a lot of people will try to do that where they'll say, okay, we'll buy TIPS, we'll short treasuries, but they're still not going to make money when the bonds sell off, right? They're just going to not lose as much, right? So it's been really a pleasure and a joy to innovate in the financial markets, take something that I think is very much in name only and access that other measure of inflation.
Right. And while we're talking about inflation, and you mentioned the different risks that are still posed, what are your thoughts around the present state of inflation in the US? And are there any specific areas of risk that you can point to there?
Oh my gosh, there's so much on the. I mean, if you look at financial markets, you'd be like, there's no risk, right? Because credit spreads are near all-time tights. I know you majored in credit, right, at Rutgers. It's kind of cool. I didn't know there was a credit major. But yeah, credit spreads, they can only go to zero, right? So if you look at some of the credit indices out there, especially short duration credit, it's crazy tight, right? Like, let me just pull up the investment grade credit index. If you look at like the 3-year credit index, the CDX market on that, it's currently, so tight that, it can only go to zero. You're taking spread risk on top of treasuries. And it's just, I don't think people are getting paid for that. So there are a lot of risks out there, but they're not really in pricing, right? Everybody's sort of like, everything is good, it's soft landing. Like, don't worry about the treasury refinancing debt. Don't worry about, the fiscal spending. Don't worry about, hey, even things like the US election. Like,
why do you think that is? I mean, that's something that, I also look at it a lot just from the retail, consumer or investor, where they just don't seem to have a lot of fear around the markets right now. Everything seems it doesn't seem as chaotic, I guess, or as chaotic as one might have thought it would get.
Yeah, no, for sure. I mean, if you close your eyes and you say, okay, here we are in, like, take 2022, right? Everything was awful in 22, right?
Yes.
Inflation was running really hot. All asset classes were going down. People were losing money in stocks, bonds, everything, right? Maybe with the exception of real estate, which was going up probably with pandemic related, labor, market shortage issues. But everybody was really negative in 22 for the most part. Then if you just close your eyes and are like, our 22 sentiment was so terrible, and now we've had the Fed hike interest rates to 5.25, right? In about a 12-month period. Like, would you expect markets to be higher or lower, right? I think the majority of people would have been said lower, not higher.
Yeah,
So
absolutely.
it's like opposite day right now, because there is a lot of euphoria in markets. Kind of everything has gone up. In 23 we had a huge rally in both the bond and stock market into the end of the year, and then this year has been pretty strong, and everybody's sort of expecting the Fed to be cutting rates, b, inflation to be cooling, and like everything is awesome, right? It's like the that movie.
Yeah.
So it's actually a great time to be positioning to own inflation in your portfolio, because everyone is so complacent that inflation's not going to be a problem, and the Fed seems pretty set on starting the rate cutting cycle, and you kind of have to wonder, like, is it really not an issue? Like, I don't know. I mean, look around. Like, I feel like every day I see inflation in my day-to-day life.
Yeah,
It's
definitely.
definitely something that's pretty sticky and can be quite cultural as
Yeah.
well.
And I mean, on that topic, with the anticipation of the rate cuts coming, what are your like thoughts on how that will influence portfolios? And do you think that the credit markets have weathered the storm?
Well, credit spreads are extremely tight. So you have to understand that when you take a bond, whether it's investment grade, high yield, levered loans, floating rate debt, preferreds, private credit, even
Mhm.
everything in that space is taking corporate credit risk, which is a very similar beta to equity risk, right? Because it's all corporates. And so I think it's just really important that, people don't go on strategy name only, because you could have, say, short duration. Oh, I own short duration, I'm good, right? But it kind of depends what's inside of it, because if it has a lot of leverage, or mortgages, or credit, that's not maybe as risk free as people like to think. So I think for me, I think inflation is one of those things that a lot of people are kind of seeing as a trade. Like, I feel like a lot of people are speculating, oh, inflation's going higher, it's going lower. And to me, I like to say, I love. Did you see the Barbie movie, by the way?
I did. I did see the Barbie
It was
movie.
fabulous. Well, I love to say, with a big smile, that like we live in a real world. This is not Barbie world. And, it's
Yeah.
it doesn't really matter what industry you're in or what you do, but everybody has a limited amount of savings, right? And income. And I think especially as you get closer to retirement, you might not have that income, but you still have a cost of living. So I feel like everybody should have
Yeah.
some exposure to inflation in a well-balanced financial portfolio. And it's not really a trade to me. To me, it's more of just like something people should own. And then the other interesting thing, with indexing has been wonderful and gives access to so many markets, but a lot of the fixed income indices are weighted based on market cap, right? So things
Mhm.
like the ag index, it used to be called the Lehman Ag, and then it was the Barclays Ag, and now it's called the Bloomberg Ag. But it's a super old index, and it has no inflation protected bonds inside of it, like zero, and about a third of it. Yeah, isn't that
That's
crazy?
pretty good to
And people say, "Oh, it's core fixed income." It's just old, and tips are new. And then also, anytime that you have mortgages in your bond portfolio, if you think about it, like homeowners are long the option to prepay. If you own the financial mortgage, you're actually short options to homeowners. And whenever you're short options, you're short vol. So I think a lot of people don't really
Mhm.
realize that they have this embedded short volatility in their bond portfolio. And it's not VIX, right? It's not equity vol. It's actually fixed income vol. And so that's another one of the solutions that we wanted to provide with our funds, was giving access to long fixed income volatility because everybody, for the most part, is already naturally short vol.
Can you could you explain that a bit more? So when you say giving access to the long fixed income volatility, like how exactly are you able to do that for individuals?
Yeah, so we have ETFs. So they're, anyone, whether it's an institution or anyone, they're 1940 Act funds,
Mhm.
sort of like I'd say the newer mutual funds, right? They're not mutual funds, they're exchange traded funds, but it's just a commingled fund
Right.
that invests. So it's just like the rates market is something that a lot of people just don't think about, right? They have stocks and then they have bonds in their financial portfolio, but a huge amount of exposure in the US market is actually interest rates. And that market's hard for a lot of people to invest in, even institutional investors. And so we actually have the ability to access the rates market, which is really unique. It's a huge market. It's one of the biggest markets in the world. And it's also very important because a lot of people have, because of the passive indexing and kind of the move to systematic strategies, a lot of people have that huge exposure to short volatility because so much of the index is now mortgages. Like we heard today,
Mhm.
it's March 20th. The Fed just had their monthly, the press conference today, and Powell was talking about, the mortgage exposure on the balance sheet, right? They don't intend to hold mortgages on their balance sheet long term, but most individuals hold mortgages. And the mortgage market, prior to, if you go back, way back, like before the savings and loan crisis, it was all an OTC market, right? People didn't own mortgages in their portfolio. They had to be QSIPed, and then they became tickers, and then they were being able to add them to indices, and companies like yours could put them into indices. And we did that with the rates market, but instead of being short options, we're long options. So whenever you're long options, you're long volatility.
Yeah.
Now, it's not equity vol, it's fixed income vol, but that I think is a really important thing to have as part of a balanced portfolio.
So, I guess what I'm curious about, Nancy, is when you first launched the fund and, were able to give access to this new and innovative part of the market, what kind of pushback did you face, or did you face any at all? Or were people excited to be kind of putting their dollars into something new?
Well, definitely we did get, you have to have a lot of thick skin when you're starting a firm and you're doing something new because you do have a lot of people who, kind of push back and are not open minded and want to do the same old thing and just play it safe and have the same benchmarks. But I think the nice thing is there are so many, uh, so many very thoughtful investors out there who are truly fiduciaries. And when they saw what we had done, they really embraced it, right? Not everybody embraced it, but that's kind of what makes the market. And so we did have a lot of, I'd say, early success with institutional investors who are like, oh, yeah, this is amazing. um, uh, Also, a lot of even RAAs who, because ETFs, are kind of tricky because you have to get approved on platforms before the wealth management people can buy them, and a lot of that is very, very
Yeah.
much driven towards the larger firms, right? I think that's one of the things I'm pretty focused on is having more innovative strategies at some of these other firms that kind of don't allow smaller ETFs on. They just want the big ones, which are, um, it doesn't allow for a lot of innovation. But I'm definitely, I feel like we had a lot more success than people saying no. But we're still not approved on a lot of these kind of traditional wealth management platforms, and I sort of feel like their loss, right? That's unfortunate because people at those firms should be able to buy.
Yeah. No, I definitely agree with you. Um, so are there any, we've talked about the opportunity that you found and you're able to make available. Now, on the flip side of that, given your experience with the markets historically and what you've observed and looking at just the markets today and investor behavior, are there areas of risk that seem obvious to you, that investors are not concerned about or ignoring? I mean, I know we talked a little bit about the short duration investment grade bonds, but we could either sort of continue on that or any other areas that you can think of.
Yeah, I think that the big risk is the Fed's balance sheet with holding mortgages, and mortgages are such a large percent of probably regular investor portfolios. And then there's no, a lot of the institutional portfolios also, they don't have any inflation protected bonds inside of them because they create tracking risk to the ag index. So I think, the lack of inflation protection out there inside of portfolios, and also the high concentration of short volatility products, is kind of, I think, the two other concerns that I have, in addition to kind of credit generally being very tight. And so the risk reward is not particularly compelling.
Right. Going back to Quadratic Capital, you've come a long way. It's been over a decade now, 11 years. What are your aspirations going into the future for the firm?
Well, I'm really focused on getting the manager research to cover the fund. We are an active ETF, and a lot of that has been sort of a gate, I would say, where you don't get coverage by like Morningstar, right? I really am hopeful that at some point Morningstar will cover us, even though we're a smaller firm, and not just look at the strategy, and then we can, once we have research coverage, then we can be put on other platforms, like certain platforms where the fund is banned, right? It's not allowed because it's not approved yet. So it's a little tricky being an actively managed ETF. I think a lot of the people in the ETF world think of passive funds and benchmarking, and we don't really do that because there isn't an index for the market that we're accessing. So I'm hopeful that we'll get some more attention from being really a differentiated strategy. And I think the other thing is that inflation expectations are so complacent now. Everybody thinks the Fed's going to be cutting rates and inflation's not a problem anymore, and it's priced that way, right? It's just like, it's the same thing with stocks, right? When a company announces earnings, nobody looks at what did they do before. It's all about guidance and what did they expect in the future. And the same principle applies for all markets. And right now, the inflation markets are really complacent. The yield curve is massively inverted. Volatility has fallen substantially from where it was even it's crazy to think, here we are in March 24, March 23, we had, Silicon Valley Bank, and it was looking like we might have another banking crisis. And now it's like everything is awesome. Everybody's expecting the Fed to cut rates. And look, what if they do cut rates and the indices and the measures that they have for measuring inflation are not right? It's all calculated by the Bureau of Labor Statistics, and they keep revising everything. So, and we don't even know if that's the right way to calculate inflation, because so much of the CPI is what they call shelter, which is actually the owner occupied rent. And that might not be kind of relevant for a large group of investors.
Yeah, I know. It feels like whiplash a lot of the time, because you're on the brink of a crisis one day, and then you turn around and it just feels like, it almost feels like it was a decade ago, even though it wasn't. So yeah, we've become a very react and move on society somehow. But all right, well, to close things off, Nancy, what is one thing that you are looking forward to in 2024? It doesn't need to be markets. It could be markets related, but anything that comes to you top of mind.
I'm definitely excited about 2024. I think there are so many attractive opportunities out there. I think, when you look globally, the Bank of Japan has now ended their, negative interest rate policy. yield curve control is over. And so I'm really excited about kind of the normalization of the yield curve is really, what we're trying to achieve with the eyeball ETF. And the yield curve in the US is massively inverted. Like even Japan has a positively sloped yield curve and ours is massively negative. So I kind of feel like just a more normal environment is going to be fabulous. So I look forward to kind of, obviously if we have any sort of surprises, like, the Fed has to cut rates quickly, or even if the Fed does more of a higher for longer, there are a lot of different ways to make that play out. And so I'm really, really excited about that. And I think 2024 is going to be a great year.
Amazing. All right. Well, thank you so much, Nancy, for joining us on Masters of Risk. This was a really insightful conversation. It was great to kind of hear about your experiences and hear about the firm and just everything you've accomplished in the direction that you all are heading. So I'm excited to see what's to come.
Oh, thank you so much for having me as a guest on your podcast, and really hope that this is inspiring to at least one person out there. And definitely
It inspired me. So there you go.
Oh, that's awesome. Well, thank you so much again. I really enjoyed the discussion, and here's to 2024.
Perfect.